Good morning, everyone. Welcome. So today I want to spend a few minutes talking about one of the most powerful and often overlooked areas of advanced planning, using charitable remainder trust concepts in business and succession planning. But one phrase you might hear occasionally, it's kind of a funny phrase, involuntary philanthropy. So meaning, many business owners unintentionally become major donors to the IRS because of poor planning and lack of planning. They spend 20, 30, even 40 years building a business, only to discover when they get ready to sell it, there's a substantial portion may disappear to capital gains taxes, depreciation recapture, estate taxes, poor transaction structure, and many times not because they did anything wrong, but because no one ever showed them the alternatives. So one of our biggest planning conversations that we have with business owners involves, are we going to do a stock sale or an asset sale? So typically sellers prefer stock sales, buyers prefer asset sales. So you ever wonder why? It's because buyers often want a new depreciation schedule. They want to get a new step up in basis. They want to also have liability protection, while sellers are trying to reduce taxes, simplify transition costs, and maximize their net proceeds. This becomes especially important with C Corps because an asset sale may create double taxation. The corporation pays tax, and then the shareholder may pay tax again personally. This is where advanced planning can become extremely valuable. A charitable remainder trust may allow appreciated assets to be transferred into the trust prior to sale. The trust itself is a tax exempt entity, means the trust may sell the appreciated assets without the immediate taxation that the owner would normally face personally. So this is important. Charitable trusts were not created as a loophole, but they were created under Section 664 of the Internal Revenue Code. Congress created these trusts back in 1969 to encourage charitable planning, economic transition, income planning. But the trade-off is the clients receive income planning, they receive tax flexibility and potential charitable deductions. So ultimately, the remainder interest goes to charity. So let me give you a real world example. We were working with a business in Sacramento, California. The business whose company was valued at around $4 million. Inside the corporation, also, the client had a $1.3 million brokerage account. The client wanted to sell the business, but he wants to be able to keep his investment account. So at the same time, the company held municipal contracts with the local municipality, which realistically requires a transaction to remain. So prior to the transaction, we transferred 30% of the corporate stock into the charitable remainder trust. The corporation then redeemed those shares, bought them back. The result, our client received a significant income tax deduction. We improved their tax flexibility and continued management of the assets inside the charitable trust account. So, and that becomes another major advantage, of CRT type planning. But one of the biggest things is flexibility after the sale, because under the CRT distribution rules, part of the income may potentially flow out as ordinary income, capital gains income, and depending on how assets inside the CRT are managed, they may create significantly better after-tax retirement planning. Another powerful conversation that you can have with clients involves understanding that we often called four-tier tax accounting, and this applies to charitable remainder trust distributions. So because many clients assume income is income, but in reality, how income is received can dramatically impact the net spendable income, Medicare premiums, Social Security taxation, overall retirement flexibility. Under CRT distribution rules, income flows through a four-tier accounting structure. The beneficiary may receive income from different buckets depending upon how the trust assets are invested and managed. Those tiers grow and flow in order. So you have ordinary income, capital gains income, tax-free income, and then return of principal. So why is this important? Because it creates the potential to diversify not only assets, but the types of income that your beneficiary receives. So inside the CRT, the trustee may manage investments in ways to potentially generate the ordinary income, long-term capital gains income, tax exempt through income through municipal bonds, and deferred growth strategies. They may create more flexibility in retirement planning. Instead of every dollar being taxed the same, clients potentially receive a blend of income sources that could improve after-tax cash flow, tax bracket management, IRMA exposure, legacy efficiency, and many times the conversation is no longer how much income can I generate, but rather how much income do I get to keep after taxes? That's why CRT planning often works best when combined with these tax diversification strategies and also considering deferred income type strategies. And we'll talk a little bit about ILIT structures and charitable planning, retirement income design, because trust advanced planning is not simply about building wealth, it's about engineering efficient income for the future. Another powerful strategy includes what we call a NIMCRUT and flip charitable remainder unit trust, or CRUTs. These structures become important when dealing with closely held businesses or real estate, or what we call hard to value assets, meaning they don't have an ascertainable value on any given day. Because many of these assets, they produce very little income, to say like just land, for instance. But the flip charitable remainder unit trust allows the trust to begin as a net income makeup trust and then later flipped into what's called a charitable remainder unit trust, the CRUT, which produces income regardless of whether or not it's earned in that given year. So this creates tremendous flexibility. Many times planners use tax deferred annuities inside the charitable trust. Why? Because it allows deferral of current income, make-up accounts to accumulate greater future retirement income flexibility later. It allows the clients to separate the timing of the sale from the timing of the income. So one of the charitable trusts I worked on involved a functional granite pit operation. So this was a sole proprietor. We transferred the granite pit into the trust. We transferred rolling stock or trucks and equipment into the trust. Some assets involve depreciation recapture issues. Different assets receive different tax treatment, so coordination becomes very critical. But the CRT still created significant tax savings and income planning flexibility. We then used a part of the tax savings and income stream to fund a second to die life insurance policy inside an ILIT that created as a wealth replacement, estate liquidity, and legacy planning opportunities. So that's really the key takeaway today. Advanced planning is rarely one strategy. It is simple concepts working together. CRTs, ILITs, income planning, tax planning, succession planning, and legacy planning, all coordinated around helping clients, always helping their clients to be able to keep more of what they spent a lifetime building. As always, if you have any questions or have a business owner case that you'd like to discuss, bring it to us early in the process, because many of these opportunities depend heavily on timing and structure. Thank you for spending your 10 minutes with me this morning. I hope this was helpful, and anything we can help you with, feel free to reach out. Thank you again.